Let's talk about escrow accounts and the escrow account calculation as it pertains to purchase loans. So, in other words, when somebody's buying a home and they want to set up an escrow account, let's talk about how that gets figured and what that means. So, first and foremost, what is an escrow account? An escrow account is essentially just a piggy bank with the homeowner's name on it that says, like, here's their little piggy bank. And every month with an escrow account, 1/12 of property taxes or 1/12 of insurance, homeowners insurance goes in there so that when those bills come due, whether it's at the end of the year for taxes or quarterly in some states, but whenever the bills come due, they being the mortgage servicer, can go into your piggy bank and pay those bills on your behalf as a homeowner. That's what an escrow account is. So when you buy a home and you're setting up an escrow account, there are certain calculations and it's regulated by the government. So it doesn't matter what lender you use. There's a very fancy formula that's going to tell you exactly how much you have to put in that escrow account. So that's what we're going to cover here. It is worth noting there are programs, conventional financing, meaning like Fannie Mae or Freddie Mac or jumbo loans, where you may not have an escrow account. If somebody puts down 20%, in some cases, maybe even 10%, you can waive escrows. So understand that this doesn't apply to every single loan ever, but for government loans, there's an escrow account, and for conventional loans, there a lot of times there are escrow accounts as well. So going through this, here's what essentially it is. I'm going to give you the easy calculation. So if you want to play at home, you can do that. But it's usually going to be 12 months of homeowners insurance due at closing, right? And rare, very rare, and I prefer you don't. So don't go pay your insurance in advance. It's going to get paid at closing. So don't pay your insurance. We will do it at closing. We'll collect the money. We, being the lending community, will collect the money for it or charge you for it, and the title company will actually collect it and disperse it. But first year's worth of insurance will get collected at closing. So that's one part and makes for a pretty big number. Secondly, the easy way, this is not the technical way, but the easy way to calculate it is there's going to be an extra 3 months of insurance and an extra 3 months of taxes. That is essentially your escrow account. It's setting up that 3 months of insurance, 3 months of taxes. Those two things together make up that piggy bank. And so why do they do that? And that's not the real number, but again, just bear with me. It's gonna make sense here in a second. The reason why they do that is because when you close on a mortgage, most of the time, like a very, very majority, most of the time, you get to skip a month's mortgage payment. So let's just take some examples. If somebody buys a house and closes in June, they won't have a mortgage payment until August. Okay. So 3 of those months, let's say somebody closed, it doesn't matter if it's June 1st or June 20th, they're going to collect about, and like I said, I'll tell you the formula here in a second, or not tell it to you, but explain it to you. But they're going to have about 3 months. So June and July, so 2 of the 3 months are going to get eaten up just from not making a mortgage payment until August. So that's one reason why they collect about that 3 months at closing. It's because, again, it kind of covers that non-payment period. They also then they being just, the mortgage industry and how they come up with these numbers, they then want a little cushion that says, what if next year the insurance goes up a little bit? They want to make sure they have enough money in that piggy bank to be able to cover the tax or cover that bill, whether it's taxes or insurance. They want to make sure they have a little bit of a cushion to be able to pay that bill in the event that the amount goes up. So that's why they collect about 3 months of insurance. Same concept for taxes, right? So the taxes at 3 months says, man, if your mortgage payment doesn't start till August in this example, you close in June, you got about a month to 2 months where you're not making a payment. So two of those three months get eaten up. And then when the tax bill does come due, they got a little cushion in case the taxes are higher than anticipated. So that's why they have an escrow account. As far as the calculation, like I said, it's a fancy, fancy formula that says, like, and I know it, but it's not worth explaining. But the system will come up with this number that says, here's what it is. But just know it's regulated by the federal government. There's nothing you or I can do about it. It is what it is. But they calculate it so that way they have enough money to make sure they can pay the bills when the taxes come due and when the insurance comes due. So just know, another thing to look up is once this is set, every year there's an escrow analysis done on that account. So your mortgage servicer is going to look at this and say, man, The formula works. It's still perfect. It's great. But if your taxes go up, and they do when home values go up, or when people vote in higher tax rates, or when your insurance goes up, and it does because there's hail, tornadoes, and climate change, global warming, whatever you want to say. It just seems like every freaking year the insurance goes up more and more and more. So over time, the escrow portion of your payment may increase. When it increases too much, the escrow shortage is going to occur and they'll reach out to you. So there's a whole, we'll put a link somewhere down here about escrow shortages. Check that out. But ultimately, that's how the calculations come into play. The really simple and easy answer: 12 months of insurance collected up front, and then another 3 gets collected on top of that, and another in 3 months of taxes it gets collected as well. So you'll also see when you go to closing, some people ask, and it doesn't matter till the day of closing, but there's what's called an aggregate adjustment, and it's a negative number, meaning in your favor. It's a credit. It exists most of the times, but every once in a while it may not show up just because the numbers work out this way. But the aggregate adjustment is just part of that fancy formula. So if they ever said, "Oh man, they're collecting too much at closing," there'll be an aggregate adjustment that gives the credit to make sure that they're collecting to the penny the right amount for your escrow account. So if you have questions, absolutely reach out to us. Again, just know that it's kind of like 12 plus 3 plus 3. And again, we'll walk you through it if you're working with the Mortgage Mark team, and you should be. You should always work with the Mortgage Mark team. We'll walk through it and answer any questions you might have. And if you need something, please reach out to us. We're here to help at all times, you, your friends, or your family. And just remember, when you think mortgage, think Mark.